Paul, how can beginner investors spot a dangerous stock?
Well, Seth, the great news is not just beginner investors, even seasoned investors have to pay attention to these three things. So first off, do you understand what the company does and how it makes money? I know this sounds very easy. Well, yeah, Microsoft sells software and Google does the search. It's more than that. Like, how do they monetize that? I know that sounds simple, and it is very simple, but it's often overlooked. And if you do that alone, you can avoid so many problems down the road. So look at an example like Enron. When the Enron disaster happened, I would literally ask people, well, how did they make money? And no one could tell me. And it came out later, well, they were just manipulating numbers. I know that sounds crazy, and yeah, they sold oil and all that stuff and contracts and blah, blah, but if you don't understand how they make that money, you can be able to understand how they lose money. That's why I love simple businesses. Gap. They sell clothes. Is there any question that Gap doesn't sell clothes? Tesla, they sell cars. Oh, wait. Everybody says Tesla's a technology company.
That was awkward.
Okay, that's the first thing. The second thing, and this is what I always love looking at. Look at the performance of the stock versus the fundamentals. Go compare. Has a stock price risen 500% while the revenue and profit has only risen 200%? It's a red flag. Does that mean it's for sure overpriced? No. But that's immediately a red flag to me. Wait, why has the stock outperformed the fundamentals of the business? Now, keep in mind, if the company was already massively undervalued, that will naturally happen. That's a good thing. But if it's not already undervalued, and my guess is if you're paying attention to it, the average public person is not paying attention to the undervalued companies, but this is why you're watching our channel, because we're going to help you identify those things and avoid the disasters down the road. So when you look at the fundamentals, if the stock price is up a ton, but the fundamentals, the revenue and profit isn't, pump the brakes, take a further look. Again, I'm not saying avoid it. You just got to look a little bit deeper. The third and most important way, Seth, what is it?
Well, this is how I first invested, Paul. It's when people just told me to get into a great stock or bought.
What people?
People who had no idea what they're talking about, really.
And that's pretty much everybody. Guys, this is a great growing community, but the one great thing about the community and what we're doing on this channel is it's getting people who want to understand one question and one question only. Why? If you're hearing the hype from your neighbor's kid or your neighbor or the mailman or even it's the cocktail party story that Peter Lynch talks about. Peter Lynch, one of the best investors ever, says, I know where the market is at any given time based on what I hear at a cocktail party. If I go to a cocktail party and I tell people what I do, and they're giving me advice on what companies to buy, the market's overpriced. If I go to the cocktail party and people are feeling bad for me for what I do for a living, the market's underpriced. I should be buying. That's the key. If everyone else is out there buying it and talking about it, it's probably on the hype train. You should proceed with caution. Because the second that flips, you're going to have the Pelotons and all these tattooed chefs and Palantirs and all these companies like Workhorse, and they go down 70, 80, 90% very, very quickly. That is the most important part. I am programmed in a way where if I hear an average person say, Paul, you should check out this company, what do?
You did this with me. I said, Paul, you should check out Bitcoin in 2017.
And I just go, pass. I didn't even need to hear anything more about it.
Yes.
I just go, pass.
Well, at the time, because it was a dummy like me telling you to invest in something.
It's a PhD in chemistry. He's clearly not a dummy, but in the investing world, Seth doesn't have the acumen. And I literally just passed on it. I don't even need to see any fundamentals, but if some average person who has no investing experience or knowledge, first off, just anybody in general, even a financial planner told me to invest in a company, I'd say pass. I have to go dig through. I want the companies that people are going, oh, that's like such a gross company. Why would you ever buy that?
Like Hewlett Packard?
Exactly, like Hewlett Packard. All of a sudden now, everybody loves Hewlett Packard. Why?
Well, it's funny, old Uncle Warren, our Uncle Warren Buffett, he decided to buy so much of it. I said, boy, what a boring, stupid play. But this guy knows what he's doing.
Ding, ding, ding. Boring, stupid play. That's exactly what I love. Because if you think about it, if the market doesn't like it, the market won't buy it and the price falls. If the market, which is made up of a lot of retail people, love it and the price starts skyrocketing, what happens to the value?
Like the housing market?
Like the housing market.
Okay, Paul, show the viewer how you would spot a dangerous stock in 3 minutes.
So back in June, we had a company that was told to us, you got to buy this company. It just surged a little bit and it was coming off its highs from February. BNGO. I don't even remember something Genomics. Okay. So in this, BNGO. Here is what people saw. People saw this run up from $4 to $8.40. It doubled in a matter of weeks. And people are like, this is awesome. This is hype. All the YouTube stars were all saying it. So I sat there and said, okay, let me go through my 8 pillars. First pillar, I want the 5-year PE being under 22.5. First red flag. They haven't made money in the last 5 years. Okay. So next one, we want the 5-year return on invested capital greater than 9%. That means we want to see how well they invest their money. It's negative 10%. Okay, that's an X. All right, fine. Let's go to the income statement. Pillar number 3, we want revenue growth over the last 5 years. Well, they have that. 8.7 million to 18 million. Okay, it's doubled. Progress. Pillar number 4, we want profit growth over the last 5 years. Lost 23 million, lost 72 million. That's an X, guys. That ain't good. Pillar number 5, shares outstanding over the last 5 years.
Okay, this should be good.
Guys, they went from an end of 5.23 million to 276 million shares outstanding. That is 5,300% growth in shares outstanding.
Oh my.
As an example, a company like Tesla, who has diluted people, has only diluted by less than double, but probably about 80%. And this is 5,300% for this company. Pillar number 6, we want to look at debt relative to the 5-year free cash flow. Well, guys, I have some bad news. We don't have 5-year free cash flow. It's negative. So there's no metric there.
So if they have debt, they can't pay it.
They can't use their free cash flow to pay it. They got to issue shares. Spoiler alert, they did issue a ton of shares instead of paying off their debt. And guys, pillar number 7 and 8 have to do with free cash flow. They don't have any. It's losing, and they lost 21 million in free cash flow to 73 million. And their average, guys, this is all around just a bet. So here's the deal. Red flag city right here. And the company is valued at $484 million, 27 times sales. Massive red flag. Well, there's a happy ending to this. Just kidding, there's not. It went from $8. We were told we were morons in the comments, how stupid we were.
Yes.
It is now at $1.68. Mail your check to my house.
Oh, no.
I will take the money. I will buy a bunch of watches and airplanes and cars, and it'll be better invested than you putting your money in this crap.
Paul, the top comment said, when we said not to buy it, someone said, I will buy immediately. That is seriously bad due diligence. What more do you need to know?
Well, their due diligence was what? Seeing the stock price go up. That is not due diligence. That's what I mean by the hype train. And guys, this isn't the only, I'm not just pick and choosing. This isn't the only stock we have. Go watch our other videos if you're new to our channel. Tattooed Chef. The only one that I've been wrong on essentially has been Amazon and Tesla. And I still think I'm going to be quite right on Tesla. Mm-hmm. Amazon, maybe not. But I've avoided that like a plague. Every other stock that we've sat there and said avoid because the hypesters did it are down 70, 80, 90%. The better one's only down 50%. Guys, it's obvious to me, if you use this video and these 3 points to understand it and our process with our software, you will avoid major mistakes in investing. Because guess what, guys? This company is down 70% in the last 6 months. You've got to almost triple, you got to over triple your money in order to get back to even. Triple your money to get back to even.
If you want to see the process in real time, how hypesters will hype up a stock, click on this old video about bio-nanogenomics and you can see what we said about it and how grilled we got in the comments and how they're all wrong.